Pleasure to be here. Just would like to first thank the teams that work on this economic outlook, in particular the NPR team and also all the economics department and the desks. So the overarching theme of this economic outlook is tackling uncertainty, reviving growth. We have significant, unprecedented, as we just heard the Secretary General, uncertainty surrounding economic policy, trade policy, and this is having significant repercussions as well in our indicators. So we saw from the Secretary General's presentation that consumer confidence is coming down, but if you look at business confidence and other activity indicators, like the PMI composite output, you can see that in countries like Canada, Mexico, Spain, the United States, and others have experienced a decline in their activity indicators. The same thing, as I said, for sentiment indicators. One of the reasons for this is, as I said, trade uncertainty and the significant change in trade policy in the United States. Basically, this graph tells you the average effective tariffs in the United States in the last 130 years. You can see that if you take into account right now the assumption that we make in this economic outlook, which is basically tariffs from May 14th or mid-May go forward, you can see that basically the average tariff rate for the United States right now is the highest since 1936. And if you take this to the April 9th tariff announcements, then it would be the highest since the 1890s. These have significant implications, as we saw, for consumer, for investor, but also the question is, will it happen for trade? Well, in the first quarter of 2025, in fact, trade was fairly resilient. We had the largest quarter of trade growth in the last 4 years, and this is mostly because a lot of firms in the steel sector, aluminum, pharmaceuticals, front-loaded their exports to the United States to try to avoid these tariffs. That's why the trade growth has held up and has been fairly resilient. But we expect that there will be some adjustment, even though trade growth will be around 2.7% this year, which is about a percentage point lower than we had forecasted, as we'll see later. So all these consequences, lower confidence in consumer, lower confidence for investment, the uncertainty surrounding trade and economic policy is having also a consequence. And because of this, we also downgraded our forecasts for the world economy. So as we heard, right now our forecast is a growth of about 2.9%. But the most important thing, if you see this graph, if you see this table in terms of numbers, and you see the next, which is basically gives you the G20, non-G20 economies, it doesn't matter if you are a G20 economy, a non-G20 economy, if you are big or if you are a small economy, if you are open or relatively more closed, we downgraded almost everybody in terms of our forecasts. Just noticeable exceptions with Argentina's recovering from significant crisis, the adjustment, the structural reforms are paying off, inflation is coming down, and this is having a positive consequence. And in other countries, either because of particular factors, there's been an upgrade, but basically we downgrade almost everybody. In terms of inflation, as we just heard as well, we expect inflation will stay higher for longer periods of time. We expect, for example, in the United States, inflation will reach close to 4% at the end of the year, and then will come down next year. But for most countries, inflation will stay a bit higher for longer because of all these factors, even though we do think that by the end of 26, they'll be closer to their targets. In terms of risks, we first started with the risk of further trade fragmentation will harm global growth. So we have a simulation in which we say, if we have additional tariffs, about 10% from the United States vis-à-vis the rest of the world, what will be the consequence? And the first consequence is what you see in the red column, basically direct impact from tariffs in terms of output. Remember, tariffs usually tend to increase intermediary inputs and also other factors in the economy. And so tariffs will have an impact, but then afterwards there'll be additional impacts, which is impact on equity markets, usually go down, increases in savings. And so this is what you see in the green and orange line. So the overall impact for the United States will be about, after 2 years, about 1.6% growth less, and for the world, less than 1% growth altogether. this is a significant risk. This is very important to get trade agreements, get to the table, get trade agreements so that we avoid further trade fragmentation. And in fact, we lower trade barriers. On the other hand, we also know that, as we saw in the presentation of the Secretary General, debt levels are fairly high. And in fact, not only debt levels are already very high, but also spending pressures are rising. So we have defense expenditures that are rising. We have expenditures related to the green transition that also are quite important, and they are rising. And on the other hand, we also have spending associated with the aging costs. Aging is one of the big advances of humanity. We are getting, in terms of life expectancy, 2 years per decade. But if nothing happens, if policy stays unchanged, there will be a significant cost. And here you have the cost for your economies in terms of pension expenditures, long-term care, and also health expenditures. And for certain countries, this is a big item and will add to the spending pressure. So basically, these future spending pressures obviously pose a significant challenge for public debt sustainability, and this is a risk going forward. On the other hand, we also know that tighter financial conditions have a significant risk for many low-income countries. In particular, as we see in this graph, and as Secretary General mentioned in our debt report that was launched in March, you can see that about 40% of debt that will be refinanced and needs to be refinanced in the next 2 years is from highly speculative debt. So, there's a risk that refinancing might be difficult for some of these countries. And on the other hand, in terms of financial market as well, there's historical elevated valuations in many of these equity markets. And so if there's a shock, a negative shock, this might pose a vulnerability going forward. So what type of policies, since we have these conditions, what type of policies is the OECD recommending right now? So first of all, first and foremost, top policy priority, negotiations and especially trade agreements, dialogue going so that we are able to lower trade barriers. In this graph, what you can see is the OECD forecast in December for trade growth compared to what is our forecast right now. You can see there's a big gap between the two lines. We are revised down significantly our trade growth projection, and this means basically if instead of having additional trade barriers, if we lower trade barriers, as we saw the simulation before, we'll have a positive impact on growth. On the other hand, monetary policy needs to remain vigilant, since now we have an environment in which goods price inflation ticked up a little bit, service price inflation continues to be fairly sticky, at the same time that we have additional pressures from the tariff environment. So basically, monetary policy needs to remain vigilant going forward. And on the other hand, given the big spending pressures and the high debt that we have in the world economy, it's quite important to be able to take some fiscal action and go back to fiscal discipline for many of the countries. We don't expect significant fiscal consolidation for most of the countries that we follow. Having said that, we do think that, first of all, in this graph you can see what your average country is spending on the different items, and we think in many of these items it's possible, if you undertake spending reviews, to find spending efficiencies, but more importantly, we also think that it's quite important to strengthen medium-term frameworks, so fiscal frameworks in the future. Don't look only at the short run, think about medium and long term. What are the consequences? So establish these medium-term fiscal frameworks, introducing, if you don't have them, independent fiscal institutions, and also broadening tax bases and lowering rates sometimes, depending on our circumstances, might be a good option going forward in terms of fiscal. Above all, we think that right now, in order to revive growth, you need to do one thing that is absolutely essential, which is revive investment. So in our special chapter, we have a lot of evidence, new evidence in terms of investment. And first of all, we know that investment is one of the contributing factors for lowering the output growth, potential growth in the past few years. So in the blue columns you see investment there, and productivity has come down, but in particular also investment has been fairly weak after the financial crisis. And you can see this particularly in these graphs that show what happened after the global financial crisis and after COVID. So the actual investment line is the blue line. The dotted line is the trend that existed in terms of investment before the global financial crisis. The dotted orange line is the trend that existed before COVID. And for OECD countries, investment went down by an average 22% after the global financial crisis, and went down in terms of business investment, in terms of housing investment, and in terms of public investment. And with COVID, another additional 7%. So we have a big two cuts in terms of, or declines of investment after the global financial crisis and after the COVID. And for emerging market economies, even more, a 33% decline in investment. So reviving investment is absolutely key. What type of investment? Well, investment is changing. We present a lot of evidence. A lot of investment right now, rather than be traditional capital stock investment, is mostly investment shifting towards more digital and knowledge-based economies. Here we have several items in terms of ICT, in terms of research and development and software. The United States is investing a lot more in these areas than almost everybody else, and this has big consequences not only for investment but also for productivity. In recent work, we showed for the G7 economies that there is a widening and increasing divergence in terms of productivity between the United States and others. But investing in ICT, investing in R&D, investing in software and data is going to be absolutely key to revive investment in your countries. On the other hand, housing investment has been very weak. In many of your countries, there's significant issues regarding housing affordability. House prices went up quite significantly compared to income growth. And this is seen in the graph here, where you see countries like Portugal, Canada, the United States, Netherlands, and others, in which house prices since 2015 increased a lot more than income growth. And so housing affordability issues became quite prevalent. So very important to increase supply, reducing zoning restrictions, permits, to increase supply, densify cities to be able to address these housing affordability issues. We have several analyses and several recommendations in our economic outlook, but this table basically summarizes the main recommendations we give to your countries and in our country notes. We think that in terms of reviving investment, you need to boost competition, also increasing public investment, in particular in areas like energy security, critical infrastructures, strengthen transportation networks. All that is going to be very important to boost public investment. Also, addressing skill shortages. If you remember, last economic outlook, we said that there is, in more than close to 40 countries, significant skill shortages around the OECD. And so it's absolutely essential to address these skill shortages to improve investment, but also other recommendations on housing and on financial markets and so on. Let me sum up. So remember, we are in an era of very significant and unprecedented uncertainty. This is having an impact for consumption, for investment, and for activity. And that's why we downgraded most of the outlook for most of the countries. In terms of policies, the most important one, remember, the top policy priority is to lower trade barriers so that we are able to boost growth and have less inflationary pressures. We also think that it's quite important for fiscal discipline to come back to some of the countries to ensure fiscal sustainability. Vigilance in terms of monetary policy, but the most important factor in terms of reviving growth is to revive investment. Investment policy should be a top priority for the medium and long term, and we hope that our recommendations are able to provide shed some light on these issues for countries. Thank you.
Thank you very much, Alvaro, Secretary General. We'll now move to questions for those here in the room. For those online, please feel free to put your questions into the Zoom. We'll try to get to some of those, but here in the room,